Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Opendoor Technologies. So Opendoor Technologies, what it does, why it's a compelling investment. We're going to talk about its profitability and then we're going to talk about its valuation. So just a bit of background here. So you can see here in this graph that in the blue line, Opendoor Technology has kind of followed that de-SPAC trade. So from February into May, there's that sell-off taking place, and then from May, things are kind of stabilized and really starting the back end into Q3, really like early September, we can see that its path to profit, its share price has started to appreciate. Investors have started to think, okay, actually maybe there is something here that's worthwhile considering. And you can see that in comparison, Zillow Group has actually not come back up, it's kind of just continued slowing down. So let's just dig in a little bit further here. So one of the things that I think is worthwhile considering is the Q3. You can see that yellow line there is expected to be up 461% year over year. Okay, so obviously that's always going to be easy because of Q3 last year where it was negative 72%. So it was always going to be an easy comp. But this pace of acceleration is really very significant. Okay, that's the first thing I wanted to note. The next thing obviously is the Q4 will probably follow a similar profile because Q4 last year was negative 80%. So obviously this year it's going to be very, very strong again, Q4. But the point here is that its growth rate is so fast that the company is saying that by the exit rate of Q4, it's going to be pulling forward 2 years worth of its financial trajectory. In practice, this means by Q4, it's going to be on a run rate of 10 billion in revenues, okay? So if you think about it, this was where the company was supposed to be at the end of Q of 2023. So it's growing really, really fast. So obviously, home price appreciation has played a role here. But underlying this, you have to think about what the prospects are for 2022. What kind of revenue growth rates can Opendoor come out with next year? That's a big question that lingers on people's minds. And analysts for stock, you can see here, even going into the back end of 2022, they're still expecting close to 70% year-over-year growth rate. So I don't know, that seems really, really bullish for me, from analysts. But even if you don't expect it to be so strong, even if you say for the year as a whole, they come up at approximately, let's say, 60% growth rate, which is a meaningful decline from what analysts are expecting, it's still really a very strongly positioned company here. So what does Opendoor offer to home buyers? To home sellers. So it offers peace of mind, okay? You come in, you do your video, you show to a representative your house, and someone comes over to do like some checks and inspection, and they give you within, let's say, a few days the cash for your property. So it's just a really fast process. And if you think about it, some of the best companies in the world that we've seen, it's really about delighting the customer. You think about Tesla, you think about Amazon, you think about Apple. So some of these companies, it's just about, it's offering something to the consumer to unlock their expectations. So if you compare with other ways of doing business where you're having to repair your property and you're having to list the property and then you have loads of viewings and it's just like a really cumbersome process, here it's like within a week you're done and dusted. So yeah, you might have to suffer a little bit on a percentage point in terms of selling your property. And I was really bearish this company before because I didn't really understand it enough. But now actually, the longer I've actually followed it, I've actually become a shareholder. So there's my disclosure right there. I'm a shareholder here. But I understand that sometimes, like some people just want the convenience of being able to go somewhere. You don't want to be in a chain locked up for 2 years. I was selling a property for 2 years, and when the first person came to tell me, oh, this can last up to 2 years, I thought, this person's talking nonsense. 2 years it took me, and I was aggressive, and I couldn't do much about it. So this is what. So many people say, oh, Opendoor Technology has this machine learning technology. It's not so much about that. It's not that difficult to price a property. What it really is selling, what is the business proposition, is really about the convenience. So you can see here, okay, so On the left hand side you can see Opendoor Technologies, how it compares on a net promoter score of 70 versus the slightly grayed out traditional listings. It's practically double what customers are expecting to see from traditional listings. So it's a category leader by far, and category leaders typically get rewarded in the market, in the stock market. So one more thing that I wanted to highlight is that the company is growing at a reasonable rate, but it's already on a non-GAAP metric already profitable. So you got a business that's growing very, very fast and it's profitable. I mean, this is really what investors would love to see, and the share price doesn't reflect that yet. So there's some calculations that I wanted to put out there. So let's just say, for the sake of comparison, okay, so there's a bit of deceleration on the EBITDA margin for Q3 because home price appreciation is going to moderate. But if you think about going into next year, as they get more scale, that's going to be able to offset some of the home price appreciation. So you get more scale. I make the case that its EBITDA margin next year is going to be approximately 2%. And if that is the case, then investors shouldn't really be thinking about it on a price to sales multiple, because I think that's really not helpful here. I think because the business is very capital intensive, and it's not really, we're not talking about a sticky customer model. So I don't think it's worthwhile thinking about it on a price to sales metric. I think if you think about it on an EBITDA metric, you'll see that this is very cheap in any case. So the business is growing at more than 60%. If you make 2% EBITDA margins next year, that comes up to approximately 250 million of EBITDA. So that puts the stock trading at approximately 65 times forward EBITDA. Now, that's not forward sales, that's forward EBITDA, okay? So if you look elsewhere, you're not going to see too many businesses that are growing at more than 60%, priced at 65 times forward EBITDA. I mean, you can look elsewhere. This is very, very compelling right here. And I mean, I can't drive this home enough that you're not going to see too many businesses that have such a long runway, founder-led, just disrupting the business model, category leader, priced it like this. I mean, this is something that I think is quite compelling. In any case, if you want to find out other names that I'm interested in, don't forget to check out my marketplace called Deep Value Returns. You're welcome to check the reviews to see what other people said about my platform. You can see the 5-star reviews. And I'm just about helping you become a better investor. So if you really want 1 or 2 ideas a month, something, if you haven't got the time and inclination to get involved and find new stocks, check out my marketplace, Deep Value Returns on Seeking Alpha. Thank you. See you soon. Bye.